Hello everyone, I'm Devin Coombs, and today I'll be going over an introduction to the statement of cash flows. So the objectives of this lecture are for you to understand the difference between the statement of cash flows and other financial statements required by GAAP, including the balance sheet, income statement, and statement of shareholders' equity, as well as be able to classify changes in the balance sheet accounts as operating, investing, or financing activities. So you'll be able to leave here being able to figure out those buckets, but we will cover indirect method reconciliations and the direct method in future lectures. We'll be covering these in three pieces: the background section, the terms section, and the classification section. So if you already have a grounding of basic financial statements, feel free to skip the first section or two. So just a little background so we're on the same page. There's 4 GAAP financial statements that we're going to be focusing on in introductory accounting. So that starts with, we always start preparing the income statement. What makes the income statement so special is we use the accrual method of accounting, right? We recognize revenues when they're earned, and we recognize expenses and match them to the period in which the revenue was recognized. And so we have the matching principle and the revenue recognition principle. We create that income statement first, and that's for a period of time, generally for a year, right, or a quarter. But we generally are going to talk about it as a year. Normally a calendar year, but sometimes we have financial years. So we create that income statement for a period of time, and then afterwards we'll create our statement of shareholders' equity, also known as our statement of retained earnings, if it's a very simplified version. And this statement of shareholders' equity is going to measure the changes in equity at a period of time, over a period of time, and at a point in time. Right? It's going to show transactions from the prior year to the current year, and then what the balance is at the end of that current year and the end of the prior year. And it's going to show the increases in revenue and capital contributions through common stock issuance potentially, and decreases from expense and dividends. After that, we create our balance sheet. The balance sheet is just the accounting equation, assets equal liabilities plus equity, and is at a point in time. All of these financial statements are created using GAAP, generally accepted accounting principles, and accrual-based accounting, which sometimes means that we will recognize revenue before or after we receive cash. So ultimately, we have to ask ourselves, we spent so much time developing these GAAP financial statements. Why do we want cash-based financials now? So why a statement of cash flows? We spent so much work getting off of cash basis, and now we're going back to it. Why? Well, how does a company receive its cash? We really don't get this information from an income statement, balance sheet, or statement of shareholders' equity. That's from an internal management standpoint, and from external investors, we would like to know, or creditors, right? We would all like to know how a company is receiving its cash and what are those primary drivers. We also would like to know how they're spending cash. Is the company spending cash on research and development, or are they spending cash to staying afloat on operating activities? What explains the changes in the cash balance? So cash maybe starts at $1 million for a company and decreased to 100,000. That seems pretty pertinent, as very, very pertinent information for investors, creditors. We want to know why that cash decreased. Did we make a large useful investment, or are we paying for a lawsuit? Right? All this is important information. And then why does income and cash flows differ? For example, in Tesla's March 31st quarterly 10Q filing, their quarterly financial statement, they posted a positive net income of $68 million, but they had a negative cash flow from operating activities of $440 million. We find if we go in there that that's related to an acquisition and some fair value adjustments, but that should be a big area of concern, or a big area of at least investigation from investors and from lenders, right? If we have positive income and negative cash flows, operating cash flows, we really want to understand why. And so personally, one of the first financial statements I look at when I'm assessing a company is a statement of cash flows. I'm curious if we're getting money in and how we're getting it in. Is it through operations, investments, or through financing activities? So let's do a quick question. Whenever I do these, I encourage you to work through each solution with me. I'll go through each one and understand why one is correct and why one isn't correct. You should understand why it isn't correct, because that'll help you get a full understanding of the problem. So each line of a multiple choice question is another opportunity to learn. So which of the following is false? A company can have positive income and a negative cash flow. Well, this isn't false. We just saw with Tesla in the previous example that you can have positive income and a negative cash flow due to accrual accounting. If we recognize revenue earlier than we receive the cash, we can have a positive income and a negative cash outflow. So we know that this is not false. It's true. So that's not the answer. Negative income and a positive cash outflow. This is just the reverse of the prior one. And the income and cash flow should be correlated. They should be similar, but they're not going to always be going in the same directions. And when they aren't, it's very worthwhile to investigate and get an understanding, which is what the statement of cash flows is for. So again, this is not false. This is true. So we're going to go to the next one. Positive income in a period that it did not generate any cash. This is also not false. This is true. A company can have positive income in a period where it didn't generate cash. If I perform services for you on an accrual-based accounting, if I perform consulting services for you at the end of a year, but you didn't pay me until next year, I would recognize that revenue as I perform those services, and that might be different than this when I receive the cash, right? And so I can have positive income in a period where I perform the services as long as collectability is assured, but I didn't generate cash in that period. And then D, greater liabilities than equity and have positive cash flows. The liabilities and equity, those changes are going to affect our cash flows, but we can still have positive cash flows and have large liabilities or large amounts of larger liabilities than our equity, right? We can take on lots of debt and from that debt receive lots of cash. And so the answer here is E, none of the above. So make sure you go through and understand that cash flows here really can differ from a company's income, from a company's balance sheet, and that's why we have these separate financial statements. So a little background. Also, why do we have a statement of cash flows? From a financial analysis standpoint, each financial statement tells us something different, right? The income statement really tells us about profitability. How is the company's operations doing over a period of time, and are they profitable? And so that's what we are going to use from a financial analysis standpoint, is profitability metrics. But the statement of shareholders' equity is primarily used for valuation. When combined with the income statement, we use it to determine things like price-earnings ratios, which we'll go to in future lectures. The balance sheet is really a measure of liquidity and solvency. Do we have enough assets to meet our short-term obligations and our long-term obligations? Short-term obligations being our liquidity, and our assets to meet our long-term obligations are our solvency. So things like the asset test for liquidity and then debt to equity ratio. But the statement of cash flows tells us something completely different and sheds light on a little bit of everything, right? It tells us really about the performance of the company. Can the company generate cash from what they're doing? One of my biggest pieces of advice to new entrepreneurs is it's really difficult to have a business if you don't generate cash, unless you're in something like pharmaceuticals and have series of fundings under your belt and are experienced in that industry. Most businesses need cash as their lifeblood, and so we need to see that statement of cash flows to see if they're able to generate cash through their operations. So it really measures the performance of a company. It helps measure the profitability of a company. If they're able to get more cash from their operating activities, not have outflows, and it affects valuation, right? Cash flows are used in a series of valuation metrics, and free cash flows is a highly sought after metric. So understand the statement of cash flows is really pivotal to financial analysis, to internal management, and to external lenders and external owners. So let's go over some terms. So on the statement of cash flows, there's 3 sections. There's really 4, but we're going to cover 3 mainly. Operating activities, investing activities, and financing activities. Operating activities are cash activities related to net income. So anything that can impact net income. So if we have a journal entry, and let's say we debit cash and credit sales, that credit to sales is going to flow into net income, right? So that debit to cash or debit to AR, if we didn't collect the cash yet, is going to be considered an operating activity because income or sales was part of the journal entry. So that's where understanding our journal entries are so important. Sales, accounts receivable, accounts payable, anything that hits expense or revenue really is going to be dropped into the operating activities. And we'll see that's really related to short-term assets and liabilities. Investing activities are cash activities related to non-current assets. So if we see a long-term asset on our balance sheet, we should instantly assume it's an investing activity. There's some exclusions to these in complicated transactions. We're not going to discuss this here. This is introductory course, so just want to stay with the basics, right? Investing activities, we see plant, property, and equipment. We know that's a long-term asset, so we're going to assume that's related to an investing activity. If we buy it, it's an outflow. If we sell it, it's an inflow from investing. Intangible assets, trademarks, any of that is an investing activity. Any of that long-term assets, intangible or tangible. Financing activities are on the other side of the accounting equation, right? We have the liabilities, so long-term liabilities. Remember, current liabilities are part of operating activities. So long-term liabilities and owner's equity are all going to be in financing activities. And this makes sense logically, right? We're financing our business through what? Debtors, we're creditors, we're taking debt on, or through our owners. People invest in our company to own a part of it, through our equity. And so that's that's how we finance our business. The third way we finance it is through our income, but our income is in our operating activities. And so ideas or sections that we might see financing activities is issuing stock, issuing debt, anything that's long-term on the debt side, or in equity. There's two other terms here. We're not going to go into a lot of detail, but there's two methods to create a statement of cash flows. There's the indirect method and a direct method. Most companies use the indirect method because it's required by GAAP. This uses increases and decreases in balance sheet line items in order to determine the reconciliation for the operating section of the cash flow statement. And so you'll see prior year and current year accounts receivable, and if it goes up, we'll assume since we didn't collect the cash, we back it out of net income. We're not going to go into detail. We'll do that in an exercise in the future. Just know that indirect method is required by GAAP, and one way that companies can create a statement of cash flows, and the most common way because it's the easier way. The direct method is preferred by GAAP, but it's much more costly, and a lot of companies do not implement it because it's not required. And that uses actual cash inflows and outflows from the company's operations. So it requires a lot more recording and reporting technology in order to see what cash actually hit the books and when it hit the books, while most companies would rather just use the balance sheet and income statement and make a reconciliation. So a lot of people and a lot of students I've had are really concerned with this section of classification, but it's easy to remember if you just keep it in your bucket. So I love this slide. Practice this slide. I highly recommend it. Most transactions will fall on this. 99% of the transactions you're going to have in introductory accounting, and all through your accounting career, all the way through advanced, are going to fall into these buckets. And I still go back to this with my clients all the time when clients get confused. So current assets and current liabilities are all going to be in operating. We all know our current assets and current liabilities by this point, right? Accounts receivable, accounts payable, cash, prepaids, deferred revenue, all the current portions of those are going to be in our operating activities. Plant assets or any long-term assets are going to be in our investing activities, right? So if we buy equipment, we buy a plant, we buy property, we buy land, we buy trademarks, that's going to be investing. So any long-term assets are going to be in our investing, and then in our financing, we're going to have our long-term liabilities and equity. So when you're going through this classification exercises, all you have to ask yourself is, what is the classification of this line item? Is it a current asset, current liability, long-term asset, long-term liability, or equity? And then you can go back to these buckets and dump it in here. I highly encourage memorizing this, but I also encourage you understanding it as well, because the current assets and current liabilities always are going to hit your net income, right? The majority of the time, you're going to have a debit to AR, credit to sales, right? Debit AR, credit to sales. Sales hits net income, so we have to adjust it into operating activities. While our investing activities, we debit assets, we debit maybe a piece of land, credit cash. We debit a piece of equipment, we credit cash or credit accounts payable, right? And so the accounts payable portion would be in our operating activities, but our plant, property, and equipment is going to be in our investing activities because it's a capitalized expense. Those three sections are key. Make sure that you understand the different types of transactions and that they just fall into those three buckets. Now there's one piece that's a little more confusing, but makes sense when you really think about it. We need to disclose any significant non-cash activities on the financial statements. The reason being is it helps us understand, us being management, investors, or creditors, it helps us all understand what the company is doing from a transaction perspective that might be behind the scenes, right? That we're not going to see on the statement of cash flows because it's not going to be reconciled. And so retirement of debt by issuing stock. If we're issuing stock in exchange for debt, a debt conversion, there's no cash changing hands, right? And so an easy way for any of these transactions is if we have a large transaction, material transaction where cash didn't change hands, then we have a non-cash activity we have to disclose. These are more common than you would think. It's great to know. So conversion of preferred stock to common stock, right? If we change our preferred stock to common stock, no cash changes hands sometimes with the option, right? So because of that, it would be disclosed as a non-cash activity if it was significant. Purchase of long-term assets by issuing a note or bond. So if we buy with a note or bond, we'd see our equity go up, our debt go up, we would see our assets go up, but we would not see any cash change hands. So, right, we can pay with non-cash consideration. Exchange of non-cash assets for another non-cash assets. So if I trade you my building for your piece of land. Purchase of non-cash assets by issuing equity or debt. If I buy a building with my shares, right, or options. And disposal of plant, property, and equipment. This is probably the most common. But if we dispose of our plant, property, equipment, it's going to decrease our plant, property, equipment, but we didn't sell it. So we need to disclose that information. So one test to test everything that we went through earlier in this presentation. I highly encourage you focus on this and make sure that you complete this section before you move on with your studies. If you aren't able to understand one of these lines, please go back through the presentation and try to understand the material before you move forward, because you won't be able to create the statement of cash flows until you're able to answer these questions. So transaction, we receive cash interest on a notes receivable. I'll talk through these and why it's the fact, right? Cash interest, notes receivable. This can be confusing because note receivable is an investing activity, right? It's a long-term asset generally. But the cash interest is what we're focusing on. We receive the cash interest. Cash interest is going to be an operating activity, right? We're debiting cash, crediting interest revenue. Because it's hitting the interest revenue, cash is short-term, we're going to call that an operating activity. Same thing with payments from customers, right? That's a clear operating activity, a sale. Wages and salaries, we're hitting expense, debit, expense, credit, credit our cash. So in that case, another operating activity. We're purchasing inventory for cash. If we purchase inventory for cash, again, inventory is what? Is it a short-term asset, short-term liability? Is it equity? It's a short-term asset, right? So that short-term asset means it's an operating activity. Paid cash dividends. Oh, so this is a little different. Well, dividends going to affect assets, liabilities, or equity. We know that dividends is going to affect equity. It reduces equity on the statement of shareholders' equity. And so that makes it a financing activity, right? The financing activity is a long-term liabilities and equity bucket. Issued common stock for cash. Again, that's an increase in equity, right? So, since it's an increase in equity, we know it's a financing activity. We paid cash interest on outstanding notes payable. This is similar to the first one. Even if the notes payable is long-term, cash interest is an operating activity because it's an expense in the current period. We received cash from the sale of land at a loss. So this is a little complex and where we need to start using our critical thinking, where we know the sale of land is a investing activity, right? Land is a long-term asset. It's not a long-term liability or equity. It's not financing. We're selling it, so it's an investing into activity, investing inflow. But we sold it at a loss. That loss is going to be reconciled to net income. So we're going to adjust net income in the statement of cash flows under the operating activities section. Issued debt in exchange for land. That's a non-cash activity. We don't see. I always tell every student, make sure that there is no debit to cash or credit to cash in the transaction. If we are issuing debt, or crediting debt, or debiting land, there's no cash. It's a non-cash transaction. And then sold long-term investments for cash, no gain or loss. If we're selling long-term investments, that's going to be an investing activity, right? Our long-term investments are a long-term asset. And so you can see all the answers here. Please go and check it yourself. Make sure you understand this before we go forward into our next lecture, where we talk about the indirect method and the direct method for calculating statement of cash flows. Just as an example, everything that we discussed will be here, right? It's going to be on a statement of cash flows for a period that's ended at a certain date, and we're going to discuss the cash flows through that period, which includes our operating activities, our investing activities. We're going to be listing the inflows and outflows for each of these, the financing activities, and then ultimately our net increase and decrease in cash. And that'll explain the difference between the prior period ending cash and the current period ending cash. And then all of our non-cash activities will be a separate disclosure underneath the statement of cash flows, just so investors, creditors, and internal management can make decisions and understand how the company is transacting business. One last note on non-cash, right? If I don't sell anything in the year, but I'm performing significant trades of land, property, and equipment with other businesses, you as an investor would likely really want to know about those significant trades and if they're in my favor or at my loss, right? And that's why these non-cash disclosures are so important. So that's it for today. In our next lecture, we'll go over the indirect method and direct method. Please feel free to add any questions to the box below. And thank you for your time. Have a great day.